You know that feeling when a 500K house pops up on Zillow, and for a split second your mind goes, that's it, that's the dream. A real yard where the kids could play. A kitchen big enough to actually cook in without bumping elbows. Maybe an extra bedroom so guests don't have to sleep on the couch. Your heart does that little flutter. Then you click the mortgage calculator, punch in the numbers, and the monthly payment lands somewhere around $3,500 or $3,800. And your stomach drops like someone just yanked the floor out from under you. In early 2026, that dream is brutally out of reach for most of us. The math isn't just tough, it's punishing. Rates are still hanging around 6% after dipping a bit from the peaks. Home prices in many decent areas are stuck at or above 500K, and wages for the average person haven't magically doubled to match. Most folks earning $50K to $100K individually, or even $120K, $140K as a household, can't make the numbers work without stretching so thin that one job loss, one medical bill, or one car repair sends everything crashing, and the hidden costs pile up fast and make it even worse. My name is Nick, and I spend way too much time crunching these kinds of numbers, because I've felt that same gut punch myself. If you're in your late 20s to late 30s, grinding a regular job, watching rent creep up every lease renewal, chipping away at student loans that feel eternal, maybe raising little ones or planning to, this video is for you, I get it. We've all scrolled listings late at night thinking, if I just push a little harder, or if rates drop more. But stick with me because while the affordability math is brutal in March 2026, understanding the real numbers can stop the guilt cycle and help you make moves that actually build your future instead of just keeping up appearances. Let me ask you something honest. How often do you look at a 500K house and think, that's what normal people have? In a lot of mid-sized cities, suburbs, and even some urban edges, 500K has become the new starter or family home price. We see it everywhere. Listings, friends posting keys, social media. It feels like the logical next step for security. Lock in payments before rent goes up again. Get stability for the family, stop throwing money away. The pressure is real and constant. Rent increases 5–10% a year in many places. Student loans still loom, kids need space, good schools matter, so the urge to upgrade starts feeling like survival, not greed. But here's where the trap sneaks in. Upgrading into a 500K home with today's rates and prices often means maxing out debt in a way that limits everything else. Lifestyle inflation kicks in hard. Bigger house, bigger utility bills, bigger property taxes, bigger insurance, bigger expectations for furniture, maintenance, HOA fees. You tell yourself, it's an investment, but in reality you're trading future flexibility for present comfort, and when other life costs hit, car repairs, medical, daycare, you have zero buffer because most of your cash flow is locked in housing. Let's get into the mechanics with the actual numbers lenders are using right now in March 2026. No fluff, just what the calculators and guidelines show. A $500,000 home purchase. Start with a solid down payment scenario. 20% down, which is $100,000. That's a big ask on our incomes, but it's the cleanest way to avoid PMI and get better rates. Loan amount $400,000. Current 30-year fixed mortgage rate averaging around 6.1%, according to the latest Freddie Mac, Fannie Mae and MBA reports. Some days dip to 6%. Some creep to 6.3%, but 6.1% is a fair midpoint for good credit in early 2026. Principal and interest payment on $400K at 6.1%, roughly $420 to $450 per month. Now add the rest. PITI. Property taxes national average 2% of home value, so $417 500/month for a 500K house. Higher in high-tax states like NJ, IL, TX. Homeowners insurance $150 250/month, depending on location, age of home coverage, rising fast with climate risks. If down payment and LT, 20% PMI adds $100 300/month until you hit 20% equity. Full realistic PITI $200 $800 per month, often landing right around $3,500 for a typical scenario with moderate taxes, insurance, and 20% down. Lenders use the 28-36 rule, or close variations, to qualify you. Front-end ratio housing, PITI, less or equal to 28% of gross monthly income. Back-end ratio total debt, housing plus car loans, student loans, credit cards, etc., less or equal to 36%. Some allow 43-50% on conventional FHA. For $3,500 PITI payment, you need about $12,500 gross monthly income to stay under 28%. That's roughly $150,000 annual household income. For the 36% back end, including average debts, you're looking at $170,000 plus household income depending on other obligations. If you have $400 month student loans, $500 car payment, $200 credit cards, that back-end ratio jumps pushing required income toward $170K, $190K plus. Put only 10% down, $50,000. Loan $450,000 at 6.1% P and I tilde $2,725/month. Add PMI, $150, $250. Taxes, insurance. PITI closer to $3,600, $3,900. Income needed $155K, $180K plus household. FHA loans, 3.5% down, or VA, 0% down if eligible, lower the entry barrier. But add upfront MIP VA funding fee and higher monthly costs, often requiring similar or higher income to qualify comfortably. Now the part that really hurts opportunity cost. That $3,500 monthly housing payment is money not compounding elsewhere. Let's compare two paths. Path 1, stretch to buy the $500K house, $3,500 month PITI. Equity builds slowly, mostly principal paydown in early years. Appreciation may be 2-3% annually. 2026 forecasts modest due to high rates inventory. After 30 years, you own the house outright, assuming no refi, worth perhaps $800K, $1M with inflation appreciation. Path 2, rent a comparable place for $200, $800/month. Realistic in many markets for 3-bed, 2-bath. Invest the difference, $700, $300/month into index funds at 8% long-term average return. $1,000 month invested at 8%, 10 years, $175, 20 years. 30 years, $1 million, $4 million, $1,500 month difference, 20 years, $750, 000 plus 30 years, million plus. That's not fantasy math, that's compound interest. Renting longer while investing aggressively can build more net worth than buying at stretch levels, especially if home appreciation stays modest. Forecasts 1.53% for 2026, 2030 in many areas. Other debts push DTI over limits quickly. Average student loan payment $300, $500/month. Car payment $500, $700. Common. Credit cards $200, $400 minimums. Suddenly back-end DTI hits 40-50%. Lenders get cautious, rates rise, higher risk tier, or approval fails. The stretch to afford $500K means thinner emergency fund, slower progress to $10K/$, $20K, buffer, less room for life surprises like job loss or medical. The brutal truth, affording a $500K house in 2026 often means trading future freedom for present comfort. You're not winning by maxing out debt. You're locking in high fixed obligations that limit options for years. The mindset shift happens when you realize you don't have to buy now to be successful or secure. You can grow wealth without over-leveraging into a payment that owns you more than you own the house. That flip from scarcity thinking, I must buy now or rent forever and fail, to abundance thinking, I can build real wealth and security without dangerous debt, changes everything. Confidence grows from lower obligations, more buffer for emergencies, ability to negotiate raises, without fear, room to invest in skills, side hustles, guilt-free vacations, or family help. Walking away money feels real. You sleep better, no dread when bills hit. Now picture life without the stretch. You keep renting or buy smaller cheaper. Tilde $300K, $400K range for 2,000 2, 500 PITI. That frees $1,000 500/month to invest automatically. Compound at 8% tens of thousands, in 5 years hundreds of thousands in 10-20. Your emergency fund hits 20K faster. You max 401K/Roth without stress. Career moves feel possible. No clinging to a job for the paycheck. You say yes to opportunities, conferences, courses, side gigs, family trips. Money works for you, not against you. You start prioritizing the big levers: income growth, job hops, promotions, side income. Building buffer first, avoiding lifestyle inflation on housing upgrades. Housing becomes one piece, not the whole game. Appreciation is nice, but modest. Forecasts 1-3% in 2026. Stocks historically outpace that long-term with less risk if diversified. You don't need a 500K house to win. You need lower obligations, consistent investing, and intentional choices. The market is tough, but you're capable. Start where you are. Boost income, cut unnecessary debt, stack savings, run your own numbers, talk to a lender, or use free calculators. The math is brutal, but it frees you to play smarter, not harder. Your future self, the one with compounding wealth, calm mornings, real options, is already proud you're thinking this through. Keep going. If this helped you see the real numbers behind 500K homes and why it's okay to wait or choose differently, give it a thumbs up. And if you want more breakdowns on housing affordability and how to build wealth anyway, hit subscribe and turn on notifications. We've got your back. I'll see you in the next one. Now go run your own numbers and remember, you're building something bigger than a house. You've got this.